For today's agenda, we're going to be looking at three pillars: laying the foundation, asset and payroll structure, and finally, advisory strategies. And why does this matter? Uh, when you're when you are utilizing or leveraging some of the tax credits or deductions, you're able to have better cash flow. And with most startups, they're structured as a C corp, meaning that there's double taxation and they pay their own taxes. And one of the things to keep in mind is that, as Marion mentioned, is that the cash flow and also estimating your quarterly taxes. So being able to properly plan for your credit as well as your tax liability will help you in terms of not being surprised when it comes time to file your taxes. And with some of the strategies or credit that's available, the R&D credit. So it gives you the ability to continue to reinvest in your company. And finally, it ensures compliance. So the last thing anyone needs is to be able to not be able to comply and face penalties with the IRS or state agencies. So one of the things I want to address first is the foundation. I believe bookkeeping for business is the foundation, and having proper bookkeeping systems or having a bookkeeper to record the records is absolutely paramount in terms of documenting your expenses and making sure that not only that, but your profit and loss and financial your balance sheet are accurate. And also documentation. So one of the biggest credits that's available to startup founders is R&D credits. And it is really important to have proper documentation so that in case of an audit, you're able to justify the use of claiming the credit. So, like I mentioned before, uh, importance of having proper bookkeeping for profit and loss and balance sheet, which is especially important when you're fundraising as well, and also to know what your capital spend is, as well as when you go apply for a loan. So one of uh, the assets that we should track and keep in mind is whenever you buy equipment or software purchases. And you can also utilize Section 179, which allows you to take deduction that year, as well as bonus depreciation. And this will change as well. Currently, it's at 60%, but with the new administration, this could change to possibly 100%. So that's something to look out for. Payroll optimization. One of the things I like to discuss before we get into the other credits that's tied to payroll is classifying independent contractors versus employees. So the IRS has some guidelines on how to do this. And if you operate in California, they have really strict rules with the EDD. And I've actually represented some clients before the EDD. And it's called one of the things to look up, or you can email me as well if you can't find it, is the EDD ABC rules to classify who's an employee and who's supposed to be an independent contractor. A lot of people tend to classify people as independent contractors, even though there may be a mutual agreement. But if it doesn't meet the guidelines, then they could reclassify them, and this could cause a mess for in terms of penalties and interest. One of the things to also keep in mind is when you offer 401k health benefits, these also serves as tax deductions and also help recruit talent as well. One of the credits we're going to start off talking about is the pension startup cost credit. So what is it? So this is a credit that allows, if you set up a tax credit for your business and you establish a 401k or simple IRA or just a retirement plan, you actually receive a credit, and a credit is a dollar for dollar. Think of it as a coupon that you get to incentivize um, providing retirement plans. So one of the things that another credit under this is the employer contribution credit. So aside from having the credit to set the retirement plan up, if the employer also contributes or does a matching, you can also receive $1,000 per employee, up to 5,000 for 5 years. So this is I'm sorry, 3 years. So this is a very good credit if you're looking to also provide a retirement plan. And for the pension startup credit, it is $500 per year for up to 3 years. And for the contribution, if you choose to contribute, it is 5,000, up to 5,000 for also 3 years. So why is this important? I think this credit is great because it helps with you get the tax credit, you get employee satisfaction, and overall, it will help support your business growth. The next credit we're going to go over is called the R&D credit. So this credit um, is especially great for startups. It is really important for innovation and competitiveness, and it involves systematic investigation, development of new product processes and services. So under IRS Section 41, it offers a credit, again, a dollar for dollar tax reduction for R&D activities that you are performing in your business. This is to encourage innovation and reduce financial burden of research and development activities, which could take years. So the industry that qualify is pretty wide, but these are the typical industries that would qualify usually, depending on the activity, like such as manufacturing, pharmaceuticals, technology, engineering, anything that requires research and development. So, what are some of the activities that would qualify? So, it would be developing new products or improving existing ones, enhancing manufacture processes for efficiencies. And this could apply for certain industries, such as manufacturing, dentistry, and even winery. So there's different industry that this could apply to, as long as it meets the qualification. Creating software for sell or internal use. And actually, this was something I was thinking about too, as a tax firm, that what if I create an AI and license it out? And that would also be consider research and development as part of the business. Experimenting with new techniques or formulation. The IRS has a uh, four-part test, and this is how they determine what is considered R&D activity. So it must be for business permitted use. The activity aims to create or improve a product, process, software, or technique in terms of functionality, performance, or reliability or quality. Technological in nature. The research must be based on scientific or technological principles such as engineering or computer science. It, there's a component that has to be technological. somewhat science-based, but there is a broad view on this depending on the activity and how you justify it. But there is the elimination of uncertainty, where the activity should seek to resolve uncertainty about the development or improvement of a business component. In the process of experimentation, the work must involve a process of experimentation such as testing, evaluating alternatives to overcome technological challenges. So claiming the R&D tax credit and so one of some of the classification of R&D that we can claim are wages, which is very common where a lot of startups they have most of the R&D credit goes towards wages. And this is good. And even some businesses that are may not be startups, but they have R&D components. It's really important to document what those are, the time spent um, on wages towards R&D credit so that you can claim it, as well as material supplies. So as long as you're not capitalizing them, you can use it towards the credit as well. And contract research. So if you use a third party for R&D purposes, for research to advance your startup or your current research, this is also consider an R&D tax credit activity. So what are some of the industry examples? So there's, like I said, it range pretty wide. So fintech is one of them, as it's such as developing secure blockchain technology for financial transactions, creation of AI financial advisory platform, innovation in mobile payment solutions and digital wallets, and as well as information technology, advancement in cloud computing data storage solution, development of cybersecurity measure to protect data integrity, creation of machine learning algorithms for data analysis and automation. So these are some of the examples that are used to justify or the R&D tax credit specific to these industries, such as software development of new software application and platform, enhancement of user experience through UI, UX research, integration of AI, machine learning for smarter software solution, medical device, design and testing of wearable health monitoring devices, development of minimal invasive surgical instruments, innovation of diagnostic imaging technologies, manufacturing, implementation of smart manufacturing and for optimization, development for sustainable material, eco-friendly production method, and automation lines for using robotics and AI. A lot of times, startups, when they're in the R&D phase, they can incur a loss year after year for a long time, and the credit just gets carried over from one year to next. What makes it appealing, this credit is if your startup is 5 million in gross receipt, you can offset up to $250,000 of payroll annually. Again, so every quarter, if you have a 941, it could offset some of that. So this makes it so that you're able to get more cash flow and not have to pay the payroll taxes, which are due every quarter. Well, they're due every time you run payroll, but the filing of 941 would be filed with the credit. One of the crucial steps of R&D credit is documentation. Uh, so it is really important to maintain records such as payroll data, invoices, technical design documents, and test results. And also for wages, employee W-2, time tracking data, order of supplies related to R&D, technical certification, prototype documents, and test plans. So this is so one of the things I really encourage clients is to document as you go or review it because after a year and a half, we tend to forget and what those activities are. And I think planning is a really crucial component to ongoing to help document the documentation process. This is what I'd recommend for this is outsourcing, simply because there's a lot of rules to R&D and it can be very complex. And by outsourcing, you are leveraging someone else's expertise, efficiency, and also their experience with defending you against audit or documentation so that you can prepare in case of an audit. So using this strategy can help reduce your tax liability. So what happens if you carry a loss over year, and let's say year 5, you become profitable? So all those R&D credits actually carry over to offset futures liability. And that's why it's so important to capture it during the years that there was R&D so that it would continue to carry over. So when the company is profitable, you can use it to offset any tax liability in the future, up to 20 years. Another tax strategy is the qualified small business stock. This qualified small business stock is a stock that is really great for investors, employees who are able to get shares within the company. And this is under the section 1202 of the IRS code. This allows for up to 100% exclusion on capital gains from sales of QSBS. And of course, they're subject to limits. It encourages investors to invest as well as employee can also buy stocks directly from the company. So they would have to do that. So so who qualifies? It must be a C corporation with gross asset not exceeding $50 million at the time of the stock insurance. Uh, And also, for the person who's holding the stock, they must hold it for at least 5 years in order to qualify for 100% exclusion. So, for stock issue after August 10th, 1993, acquired after September 27th, 2010, you get to choose between the greater two, $10 million of cumulative limitation. So $10 million that you could potentially would be tax free as long as it's hold past sold 5 years after 5 years, or 10x of the basis, whichever is greater. So this makes it really great for, like I said, uh, startup founders, investors, as well as employees to get in early when the company is evaluation is under $50 million. In
In
conclusion,
conclusion,
uh, Qual- QSBS offers significant tax advantage, making it a valuable tool for startup to attract investors and talent. And when it comes to tax planning, one of the things I encourage is to have a plan and to do proactive tax planning and not to be reactive. And I think it's really important to find someone and work with them early on so that you can have a plan of action to capture the credits and plan for the credits or deductions as well. Second thing to look at is entity structuring. Some of the strategies may require you to be a C corp, which is a lot what most startups are. But occasionally, depending on the entity structure, it would affect the taxation, how it's being taxed. And of course, you know, look for R&D credits.